Let's talk about FreightCar America, ticker Rail. We're going to take a close look at this company, its potential, and the challenges it faces in a dynamic market. Is this a hidden gem or a value trap waiting to ensnare unsuspecting investors? Not a flashy tech stock grabbing headlines with promises of revolutionary innovation, but a classic industrial company building the backbone of our economy railcars. These are the unsung heroes of logistics, quietly moving goods across continents. After years of struggle marked by economic downturns and internal restructuring, FreightCar America is trying to stage a comeback. They're looking to revitalize their operations and recapture market share. They've restructured, streamlining their operations and reducing costs. They've also shifted production strategies, focusing on efficiency and innovation, and are aiming to ride the wave of renewed interest in rail transport. The winds of change are blowing and rail is gaining momentum as a vital transportation solution. Why now? What's driving this resurgence of interest in rail? Supply chains are evolving, becoming more complex and demanding, and rail is becoming more attractive, a key piece of the puzzle in optimizing logistics. Cheaper, offering significant cost savings compared to other modes of transport. Greener, presenting a more environmentally friendly alternative for moving goods, and more reliable for long hauls. Rail provides a consistent and dependable solution for transporting goods over long distances. The company's made bold moves to become leaner and more profitable, streamlining operations and focusing on efficiency, catching the eye of value investors. These investors are always on the lookout for undervalued companies with turnaround potential. But is this a real opportunity for growth and sustained profitability, or a value trap that will ultimately disappoint? We're diving into what they build, the different types of railcars they manufacture, and the industries they serve. Their financials, scrutinizing their balance sheets and income statements to assess their financial health, and their competition. We'll analyze the competitive landscape and see how FreightCar America stacks up against its rivals. We'll see if there's a path for rail, a clear trajectory for growth and profitability in the years to come. To go from forgotten industrial, a company struggling in the shadows, to portfolio powerhouse, a key player in the transportation sector. Is it time to get on board and invest in FreightCar America? Let's find out. FreightCar America designs and manufactures a diverse range of freight railcars, the backbone of the North American rail network. They are instrumental in moving goods across the continent. Among their offerings are covered hoppers, essential for transporting grains, fertilizers, and other dry bulk commodities, protecting them from the elements. They also produce gondolas, robust open-top cars designed to haul everything from scrap metal and aggregates to wood chips and other heavy materials. Flat cars and more, including specialized flat cars for intermodal transport, carrying shipping containers and trailers efficiently across long distances. Once primarily known for coal cars, a staple in the energy sector, they've demonstrated remarkable adaptability, strategically shifting focus and diversifying their product line as the market changed and energy demands evolved. This foresight has been crucial to their continued success. Their game changer? What really set them apart? It was the bold decision to consolidate production into a single, state-of-the-art, highly efficient plant, streamlining operations and maximizing output. This strategic move centered around their facility in Castaños, Mexico, a location chosen for its logistical advantages and skilled workforce. The result? Significantly lower production costs and a substantial increase in manufacturing flexibility, allowing them to respond swiftly to market demands. This move lets them quickly pivot to whatever car type is in demand, optimizing their production schedule and catering to the specific needs of their customers. This agility provides a huge competitive advantage in a shifting market, allowing them to stay ahead of the curve and maintain a strong market position. Their product lineup is now remarkably diverse, reflecting their commitment to meeting the evolving needs of the rail industry. Furthermore, they're investing heavily in research and development, focusing on lighter, more efficient designs that maximize payload capacity. Lighter cars mean more cargo for customers, a direct benefit that translates to increased profitability and improved operational efficiency. This commitment to innovation gives them a significant edge in the industry, solidifying their reputation as a leader in freight car design and manufacturing. With over a century of experience, steeped in the rich history of railroading and a modern manufacturing base equipped with cutting-edge technology, they are well positioned for continued growth and success. They seamlessly blend tradition with innovation, honoring the legacy of railroading while embracing the advancements of modern engineering. That's their 1-2 punch in a tough market, a blend of experience and innovation that keeps them competitive and resilient. Alright, let's dive into the heart of the matter and check the numbers. We need to understand the financial health of FreightCar America to truly assess its potential. We'll be scrutinizing key indicators and performance metrics to get a clear picture. The good news is that FreightCar America's revenue has surged impressively, topping $450 million in 2024. This significant increase demonstrates a strong demand for their products and services. This revenue jump is a clear sign their new strategy, implemented to revitalize the company, is indeed working and bearing fruit. It suggests that their strategic decisions are resonating with the market. Furthermore, their backlog is remarkably strong, representing nearly a year's worth of production at current capacity. This provides a solid foundation and gives investors increased confidence in future sales and revenue streams. However, profitability is still a significant challenge that the company needs to address. The company has faced years of losses, a persistent issue that needs to be turned around for long-term sustainability. Adding to the pressure, high steel prices have significantly impacted their cost of goods sold, squeezing profit margins. And the costly move to Mexico, while strategically important for long-term competitiveness, has further squeezed margins in the short term due to relocation expenses and initial operational inefficiencies. While they're posting positive adjusted EBITDA, indicating some operational improvements, net income, the true bottom line, remains elusive and a key area for improvement. Debt is another significant concern that warrants close attention. They borrowed heavily to fund their turnaround initiatives and expansion plans. Compounding the issue, high interest rates add further pressure on their financial performance, increasing their debt servicing costs. So, the financial story is one of rapid growth in revenue, driven by strategic initiatives and market demand, coupled with a healthy backlog that provides a buffer against market fluctuations and ensures future production. However, profits and debt remain big question marks that need to be addressed for long-term financial health and stability. All in all, it's a classic turnaround situation, high potential for growth and value creation, but also high risk due to existing financial challenges. Can they keep their balance between growth, profitability, and debt management? That's the key question that will determine their ultimate success. FreightCar America faces giants, Trinity Industries and Greenbrier companies. These rivals have scale, diversified businesses, and steady leasing revenue, making them tough to beat. Rail, by contrast, is a pure manufacturer, more exposed to market swings but also more agile. Their edge, specialization, and a low-cost, flexible plant in Mexico. They can undercut on price and adapt quickly to customer needs. The risk getting squeezed by bigger players. The reward carving out a profitable niche. It's David versus Goliath. Can Rail's lean model win enough business to thrive? The future? It's all about execution. Rail must keep optimizing its Mexico plant and innovating new designs to stay ahead. Risks loom large. The railcar market is cyclical, and a recession or spike in steel prices could hit hard. Analysts are split. Some see big upside from growth and backlog, others worry about debt and competition. Bulls say the turnaround is real, and the stock is undervalued. Bears point to past losses and warn that one misstep could derail progress. The analyst divide says it all. Rail is a controversial high-stakes bet. The outcome, still up in the air. FreightCar America stands at a crossroads. A bold turnaround, surging revenue, and a modern product lineup. But don't expect dividends. Every dollar is going to pay down debt and fuel growth. The stock is volatile. Big swings on news, and not for the faint of heart. Risks are real heavy debt, thin profits, and fierce competition from industry giants. Betting on Rail means believing management can keep executing and the economy stays strong. Bottom line, this is a high-risk, high-reward play for speculators, not conservative investors. If you crave explosive growth and can stomach the volatility, keep Rail on your radar. The train's leaving the station. Destination unknown. Booyah!